Hi, everyone. Thank you very much for coming out in such force again for the 14th Master Investor. And I think this is the 7th or 8th time that I've spoken here, and I really appreciate the turnout and the interest. I think this is the best show we've had. My friend Richard Reed, who's here, and whose wife is here as well, and they're having their first baby tomorrow, has called it the Glastonbury of investment sort of forums because it's happy and because there are also better toilets than Glastonbury. So we wish Richard and Nadia all the best for tomorrow. I'm going to talk today about a change that's happening, and I think it's a positive change if we embrace it and we understand it in the investment world. And that is the beginnings of the end of deflation. Deflation has been an absolute disaster for investors in the last few years, and I will bet you most people in this room have had pitiful returns, if anything, on their portfolio. And that is the direct result of the intervention of a group of people who I'm going to highlight later on. All the things that you see behind me on this screen here, the North Korean situation, the terrorist situation, the Euro crisis, potential Brexit, and all that sort of stuff, are really irrelevant to the future of investment. They are irrelevant because although they make for volatility on a short-term basis, they are not going to influence the long-term outlook for your portfolio. And people talk about Brexit, and I'll mention it very briefly in this speech, which is non-political. People talk about Brexit and say, oh, the pound will go down 15% if Britain leaves, or it will go up 15% if we don't leave, and so forth. I will bet you anything that everything has already been priced in to the value of the pound and the value of the stock market, neither of which I think are stunning buys nor stunning sells. And I'll cover that later in my presentation today. However, Donald Trump is a very interesting character, a misogynistic bully, I think is probably the best way of describing him. But he has contributed one thing to humanity that I think we should all take note of. I want to tell you a little story about Donald Trump. Some of you may already know it. Donald, or the Donald, as we prefer to call him, has a butler who's an elderly butler who's worked for him for many years. And he reads the Donald's moods. So when the Donald has had a bad day and comes back on his helicopter to his awful palace in Florida, if he's had a bad day, the butler arranges for a bugler, not joking here, to play the American equivalent of God Save the Queen, which is called Hail to the Chief, as he gets off his helicopter. Furthermore, Donald likes to wear his hats. And if Donald's in a bad mood, he wears a red hat. If he's in a good mood, he wears a white hat that says, Make America Great Again. And as I said, this is a great contribution to mankind and indeed to investing, because we have with us today 250 hats, which my colleagues are going to distribute right now to those people who look enthusiastic, who believe in investing, who think it should be a happy and collaborative thing and not a viper's nest of bile and vitriol. And we've also got some placards, which I want you to hold up. And we're going to take some photos of the audience here, looking happy, looking excited, looking at great, because the prospect of positive return for investment is once more with us, ladies and gentlemen. And here is the hat. A little bit snug on my head, but hope it looks good anyway. Thank you very much. So, let's get into the meat of this. The only important thing that matters in investment is the direction of monetary policy. Now, as you will recall, the financial crisis gave the world a new set of monetary tools, which were employed in a coordinated fashion to begin with, at a time of very fragile stock markets, and economies, by central bankers around the world. This was known as quantitative easing. Everyone is familiar with quantitative easing. And I believe that at the time, 2008 and 2009, with the imminent bankruptcy of many big banks around the world, that Make Investing Great Again. That's Richard Reed there, holding up the placard. Thank you. I believe that was necessary. But the problem is that the central bankers of the world have taken this to their hearts in a very pernicious and bad way. And the result is that today we still have quantitative easing in a variety of different forms, and in some cases they're even talking about doing more quantitative easing. Quantitative easing is very bad for our economies and for our stock markets and for investor returns for reasons that I will describe to you. But the effect of this central bank nonsense, which has now persisted for 8 years, is that interest rates have gone back to Babylonian times, if that can be believed. In fact, going back to the time of Babylon, interest rates have never, ever been so low. The average bond yield in the major bond markets of the world across all durations, that means from 6 months to 30, 40, 50 years, is 0.65%. Not an attractive prospect for anyone who's thinking about retiring or building a pension plan or investing in insurance products or even investing in the stock market. And this is the direct result of the central bank interventions into the real economy, if you want to put it like that. Now, I want to talk to you about long-term investment returns. If you had put, say, $10,000 into an interest-bearing deposit in 1800, and you could, by the way, you could do it then, today you would have an unbelievably large quantity of money compounding at 4%. But of course, we consume that interest. So 3% of the 4% over time, over a very long period of time, that's generated by returns on stock markets, property, interest, bonds, etc., is consumed by the recipient of that interest, dividend, or whatever it might be. And that's why the long-term real return on investment is typically 1% over a very long period of time, going back to 1800. However, today, we don't even have 1% returns. As I said, bond yields are 0.65%, but in 7 countries, we have negative interest rates. That means that some fools, morons, institutions, and I don't know who else, are prepared to buy bonds at 100, let's say, when after 20 years they're going to get 95 back with no accounting for inflation. This is the madness to which the central banks of the major economies have driven our economy. Economies, not just the British economy, across the board. And only last week, or 2 weeks ago, Kamikaze Kuroda, who's the chairman of the Bank of Japan, introduced negative interest rates in Japan, and it's had entirely the opposite effect to that which he intended. Now, there are 3 reactions of people in this room perhaps as well, to when you are confronted with negative interest rates. The first is you're not getting any return on your money, so what do? So you eat into your savings and you deplete your capital, which is very bad for the world economy because it means there's no savings to go into new capital formation, the purchase of new machinery, the development of new inventions. The second is that you end up saving more for retirement and future consumption. So you're depleting your capital, but you're also saving a bit more than you did in the past. And again, that's not great because those savings could be deployed in more productive use. And the third is, and this is what they want you to do, is to move into riskier assets chasing higher returns. And what ideally these people would like you to do is to go and borrow from a bank and invest in a factory or employ people or start up a coffee shop or whatever. But in fact, what people have done is to go into riskier assets such as property, which is a static investment, it doesn't do much good for the real economy, or into art, or into things that really don't contribute to the long-term growth of our economies. Now, the lineup of these people who control our central banks is an interesting one because they have something in common, and that is that they're all from academia. Most of them have never had a proper job in their lives. They've joined think tanks. They're either lifelong bankers or think tanks, and another common thread to some of them is Goldman Sachs. And as I will show you later, Goldman Sachs is not noted for its forecasting accuracy. And between this lot, they have developed in the last few years, it's like putting a child in a sweet shop. This is like putting someone who's only read a book on how to drive into a high-performance Ferrari, giving these central bankers the keys to the world economy. This is a disaster. This has been a disaster for investors around the world. They've developed all these acronyms, and I'm going to offer someone, you can get the slides later on, by the way, if you want, who can undo all these acronyms, a bottle of expensive champagne that I will send to you if you write down if you spend several hours of your precious time in order to get a bottle of champagne, I will send that bottle of champagne to you. But there are two on here which I think we should single out as being particularly toxic, poisonous, and also concurrent. These are the ones that are the disaster that we're encountering at the moment. The first is negative interest rates, and the second is zero interest rates. And we are now in the negative interest rate zone. I pointed out what people's reaction to negative interest rates are, but the other and more important one, perhaps, is that the negative interest rates and zero interest rates have led to capital misallocation. Now, you'll hear that from quite a number of speakers and commentators about capital misallocation. But it's a very, very potent thing to talk about. There is a man called, or was called, Knut Wicksell, who came from Sweden. And I've tried to read his books, but I just read him on Wikipedia. It was so much easier. But basically, his rule is that entrepreneurs will only invest when the marginal return is above the cost of capital. And at the moment, that marginal return is barely above the cost of capital, and that's why we're not getting investment in the Western or major developed countries of the world. Productivity growth is zero, more or less, across all our developed countries, and investment is extremely low. And the result of that is that the age of capital stock, that's the age of the machine tools or the age of the factories, the age of really anything in the world that's to do with productive output is getting longer and longer. And both Germany and Japan have the oldest capital stock they've ever had in their history. So although we look at them as being successful, competent, machine building and producing economies, they are going to become increasingly less so unless there is a change in the interest rate outlook. The other thing is that with negative interest rates, you can't generate a return. And secondly, and very importantly, banks can't make a profit. Banks can't make a profit because banks typically borrow money from us depositors, and then they lend it out long to people who are buying houses or entrepreneurs or even governments. They can't make a profit in the current environment because negative interest rates mean that they just don't have the margin anymore, the net interest margin. So if the bank is getting minus 0.2 to minus 0.4% on its reserves deposited with the central bank, it cannot realistically charge its depositors that same amount of negative interest rate, because all they would do is to take the money out in cash and hoard it, or put it into gold, or put it into silver, or put it into property, or something else. So the banks try and make up this margin by charging you fees, and you'll soon see on your current accounts there'll be a monthly maintenance fee, there'll be this and that fee, fees for transferring, fees for this and that. But of course, banks are suffering from competitive pressures from fintech, which doesn't have all the regulatory burden, the burden of branches, and all that sort of stuff that the old legacy banks have. So what is going to happen to the banks? If there's another banking crisis, with the yield curve being so flat, and with no capacity by the central banks to do further major intervention into quantitative easing or such things as that, it's entirely possible they could all go bust. And one of the mistakes I made last year was that I thought, oh, maybe we could buy some banks on a bounce because they look incredibly cheap. And I did. I put HSBC up as one of my recommendations. It's down about 35% over the last year. I'm very sorry about that. All banks around the world are more or less down by that same percentage because their business model is being crucified by the actions of the very people who are supposed to protect the banking system and to regulate the banking system. And that is our muppets from academia, from think tanks, who are currently ruling the world with their disastrous monetary policies. Now, the other thing that happens is that the savings and insurance industries are destroyed, because if there is no return on anything, how do you, as an insurance company, offer a return to people on their money? How do you, as a pension provider, offer a decent return to investors on their money? You just cannot do it. And then the last thing is, when you impose negative interest rates, and by the way, this is very important, this negative interest rate thing, you give people in the country a sort of sense of malaise. They begin to think there's something wrong with the country. And of course, there is something wrong with the country. It's got the wrong person at the top of the central bank. So the animal spirits of the country are dampened. This is what negative interest rates are doing. Zero productivity growth, low capital formation, misallocation of capital, ruination of the banks. These are all bad things. And I'm going to give you some hope. I'm going to give you some hope because I think a change is going to come. But the effect of this market-distorting central bank activity is really quite remarkable. House prices in key places around the world, speculative bubbles, have become unaffordable almost universally. And you can see on this chart just what the multiple of earnings is required to buy a house, for instance, in Hong Kong, or in Auckland, or in London, or in San Diego. Furthermore, when I was young, it was entirely possible at the age of 27 or 28 to go to the bank, borrow money, and buy a house in this country. Today, for the first time ever, there are more renters in that demographic, young, aspiring professionals, who are renting and spending a large percentage of their incomes on housing. They're renting their housing as opposed to owning it. It's become unaffordable, and that is the direct result of the pernicious interference by the central banks in the pricing of money. Money is like any other commodity. It has a price, and the price has been artificially depressed for too long, creating these vast distortions in our economies. The next thing is that the banking system, as I said, is being ruined, and you can see the performance or relative performance of the banks very, very poor across the world, even though the US banking system is relatively fixed. It's made even worse by the fact that in Europe, in continental Europe, particularly in Italy and France, the banking system, and Germany for that matter, the banking system is anything but fixed. The Italian banks are bust, and the most recent action by the Italian central bank to try and get the big banks to support the small banks is like a drop in the ocean. It's totally insufficient. Italy has, on its bank's balance sheets, about 320 billion euros of non-performing loans. It doesn't have proper bankruptcy laws, so they can't foreclose properly, and the capital of the banks is totally inadequate to deal with the recognition of those loans. So the Italian banking system is bust, the French banking system is close to being bust, Spain and Portugal still have problems, Greece is going to come back cap in hand, and of course the German banking system is not efficient at all. And as you know, Deutsche Bank is close to bankruptcy again, and will probably have to be bailed out. So these distortions are legion, and as I said, I'm going to use that word again, pernicious. And ultimately, if you wish for something long enough and hard enough, you may get it, and you may wish you had never wished for it. And it's entirely possible that all this manipulation, all this tinkering, is going to lead to high inflation sometime in the relatively near future, which is why my recommendations to you later on are going to be to take advantage of that. We can make money out of this. We can as investors. We don't have to despair. Look at what happened to the Argentine peso. Look at what to the US dollar. The US dollar has lost 94% of its purchasing power since 1971. It's not that long of a period, and it lost it through inflation. Even in the UK, since 2008, we've had an average of 2.5% inflation. Sure, it's low at the moment, but I bet you it's going to start revving up again relatively soon. And then we end up with a Venezuela or Zimbabwe type situation. And the only protection in those circumstances is the sort of things I'm going to talk about later in my presentation. But just imagine today that you're 25 or 35 or 55 and trying to build a pension. It's a really difficult thing to do. Now, the best time to plant a tree was 25 years ago. But given that we're trying to plant trees today to build for the future, you must save today. You have to save. You have to, as Alan Steele so eloquently put it, defer the purchase of the car or the holiday in Lanzarote. You've got to save, because otherwise you will be living in penury. You'll be living off baked beans and sardines, or possibly even dog food. And aged 90s, if you don't save when you're now 25 to 30, you might just have enough to make that one call to Dignitas for your graceful or ungraceful exit from this world. Save now and save as much as you can, because we are living a lot longer. The idea, the fictional idea that governments are going to look after your old age has to be dispensed with in your mind. And I'm going to give you one illustration of that. In the United States, the public sector employees have a hole in their pension schemes of about $3.5 trillion today. And over the whole of the United States, very quickly, pensions are being cut by current pensions are being cut by 40 to 60% to represent the fact that there is no return. But these pension planners are still, in their actuarial schemes, suggesting a 7 to 8% return compounded over the period of the retirees' contributions into the pension plan. They are barking. So more and more people who are thinking about retiring at 65 are going to have to wake up to the fact that they won't be able to retire at 65. There may not even be jobs for them in the newly automated world, but they're going to have to save and save now. Now, I mentioned at the beginning that it doesn't really matter what the politicians do, it matters what the central bankers do. It doesn't matter if David Cameron sits out the rest of his term of office under a Panamanian palm tree drinking pina coladas, or if George Osborne sits at home with a yellow hard hat looking at Excel spreadsheets. They will make no difference, really, to the outcome of your investment strategy. What the central banks do will make the critical difference. But bad economics does drive bad politics, and we are seeing the rise of populism, and I don't think that's surprising. The top 61 people in this world own more than the bottom 3.6 billion people in this world. That is an amazing and awful statistic. No wonder that people who've got a vote but have nothing else are voting for populist candidates all around the world. So you've got the rise of Marine Le Pen in France, you've got Bernie Sanders at one extreme in America, and you've got Donald Trump at the other extreme, and Spain doesn't even have a government because they can't work out which of one of the populist parties should be in charge. All across the world, you're getting more and more of this, and it's a direct reflection, again, of the central bank's manipulation, tinkering, artificial manipulation of what should be a proper transmission for the price of money, which is not happening at the moment. Now, as this is all happening, as this populism mixed with bad economics is happening, of course, the workers are asking for more, and I would too. You can't afford your house in London, you can't afford to live anywhere. You're having to hot bed with someone who works a night shift while you work a day shift. All those horrible things that are happening. So, minimum wages, universal wages are being upped and are being talked about around the place. But if machines had a voice, they would say, yes, raise the minimum wage to £50 an hour, £100 an hour. Because the higher the minimum wage goes, the greater the minimization of work, because it just speeds up the automation of everything. So we have this. I have no solution to it. We have this time at which populists are saying, raise minimum wages, and at the same time, companies are saying, well, the machines don't go on strike, they don't talk back, they don't get sick, they run for $5 an hour. We're going to substitute people with machines, and they are doing it. They're doing it. So there's a sort of luxury communism that's beginning to envelop the world, and I'm afraid that the result of that will just be ever higher taxes, which is another reason why we have to save and take advantage of all tax breaks that are available, just as Alan Steele said earlier on, because no one is going to help us except ourselves or our trusted advisors. Now, you can see this Bernie Sanders sign. Bernie Sanders is an avowed socialist. Actually, he's a downright, he wouldn't have been around in the MacArthur era, he'd be in prison. But he's basically a communist. Now, I don't think he's going to get in, but this sort of sign illustrates what the future for us investors is unless something changes. We have to push for a change in central banking policy, which is what I'm going to talk about next. Now, so what do we actually do? What do we do to make our portfolios better? Well, forecasting isn't easier. And I always use the example of Goldman Sachs. When oil was $140, they forecasted $200. When oil was $30, they forecasted $18. I don't know what their forecast is now, but whatever it is, do the opposite of it. And then you've got examples of other luminaries, the highest paid financiers in the world, the best brains from Harvard, Stanford, Oxford, Cambridge, you name it, and they can't forecast properly. And one of the reasons is it's really hard in a monofactorial world where people move from one issue to the next. So the euro crisis, then the renminbi, is it going to devalue? Is the Fed going to raise interest rates? This moving between one asset class and the other is a function of a world in which there is no return and people are shifting money around willy-nilly just to try and generate a return. And by the way, those who do shift their money around all the time, unless you're very good at it, you will go bust doing it because the friction costs are very large, and as Alan pointed out earlier, people tend to buy when everything looks great and they sell when everything looks, at least to them, bad. So what do we do? I think there's a change coming. And Stephen Stills of Crosby, Nash, Stills and Young wrote a song for a band called Buffalo Springfield in the 1970s. And it's about change. And I think we've got there's something happening here. What it is isn't exactly clear. I won't go into the rest of it because it'll bore you, but there is something happening. And what we're getting now is divergent central bank behavior. We're getting some central banks resorting to desperate measures, and we're getting some central banks that are beginning to think, maybe we've got to regularize the situation. And the effect of divergent trends in central banks is going to give us, as investors, fantastic opportunities. Right, so I'm going to give you a very quick global tour. Don't worry, it will be quick. In the United States, I wouldn't buy the stock market in general. It's expensive. It's about 24 times earnings. Earnings are falling, believe it or not, and they're falling even in an environment of very high stock market buybacks. I talked about this last year. At the moment, US companies are spending as much on dividends and buybacks of their own stock as they are generating in net income. That means there's no extra money for R&D, there's no extra money for new plant and equipment, and they're leveraging themselves up. So US corporate balance sheets in general are deteriorating, and there are now more junk bonds on negative watch in the United States than there were in 2008, 2009. You also have a lower growth trajectory, but the US is still a very strong economy. It will grow by about 2% this year. I think the Federal Reserve is coming to the point where they're going to raise interest rates a bit faster than most market commentators think, because there's employment pressure now building in the United States. Unemployment is probably going to fall to around 4%, and the dollar is in retreat. And when the dollar goes into retreat, and I said this last year, and this has been a good call, when the dollar goes into retreat, it's normally because US interest rates are going up. It sounds counterintuitive, and maybe it is, but it's just a fact. In history, the dollar goes down when US interest rates go up. So my general view is don't buy the United States stock market in general. I wouldn't put your money into a tracker fund or into a US growth fund or anything like that, but there are selected opportunities in the United States which I still like very much. Now, as far as China is concerned, they've delayed the evil day, and they can afford to do that. They can afford to carry on taking in more and more debt because most of the debt is domestically held, a bit like the Japanese. So at the moment, China has about 250% debt to GDP on a net basis. That's growing very rapidly, $1 trillion of new debt in the first quarter of this year. But the effect of that taking on ever larger amounts of debt is diminishing. So it's taking 5-1 of new credit for every one of GDP growth. And over time, China will have a problem. They will have a devaluation problem and potentially a debt and inflation problem, but we're not there yet. And you may remember a speaker last year was very, very bullish on China. It was actually not a very good call. I am going to recommend later on a modest investment in a Chinese situation, which I think will suit everyone, because when things look really bad, sometimes is the best time to invest. And towards the end of last year, we became bullish on Brazil, and would you believe it, the Brazilian stock market is up nearly 30% since the end of last year, even though everything, the headlines, Dilma Rousseff, corrupt, Petrobras, this and that, fighting in the streets, are very bad. Sometimes crisis gives us opportunity. So China, I think, is a good bet for the next year, but watch its economy. It's being held together by the Communist Party, pushing ever larger amounts of debt down the funnel of the economy. Now, Japan, I still like Japan very much as an investment. It's the cheapest major market, but I think Japan, in contrast to the United States, is going to introduce, for the first time ever, what is known as helicopter money. Now, this term was invented by the unlamented Ben Bernanke, to describe basically the transfer of newly printed notes or the equivalent in electronic form to the general population. And I think the Japanese are going to introduce helicopter money. We have helicopter money in this country because the central bank, the Bank of England, will never get rid of all the bonds on its balance sheet. So de facto, it's helicopter money. But they're going to say this is helicopter money, and the way they're going to do it, I think, is to introduce vouchers. So they'll give everyone a voucher. So I walk around this room with a $1,000 voucher, but you have to spend it on Japanese-made products, and you have to spend it within 3 months. That's the way they're going to try and get consumption going. Japan is a hugely wealthy nation, but with a lot of government debt. The Bank of Japan has been buying up all the government debt, basically. It now owns a third of all the government debt, which is very, very large indeed. It's having no effect on the general economy. I think the yen is going to rise. This time last year I said buy Japan, but remain unhedged on the Japanese yen, and that's probably been the right thing to do. I really like the Nikkei, because in a world where they're making returns even more difficult, when you have 3-4% dividend yield on Japanese shares, Mr. and Mrs. Mikimoto, who are in a negative interest rate world, are more inclined to buy both property and stocks. And companies are now, for the first time, engaging in buybacks, they're engaging in dividend increases, and the companies in Japan look pretty cheap. And the privatization of the Japan Post, which is the biggest savings organization in the world, is a good sign, because they're going to move away from Japan government bonds into stocks, and that's very positive for the Japanese stock market. So at the moment, the Japanese market is about 17,500 on the Nikkei, and I definitely think over the next year we'll see well over 20,000. Doesn't sound like a huge amount, but it's better than nothing. And remember, if we make a few percent a year, it's better than making nothing a year, or losing a lot of money like so many hedge funds and funds have unfortunately experienced in the last year or so. And you may have seen that Chris Benodi, our top fund manager in this country, lost 30% last month on his flagship fund, which shows that even the brightest guys find it very hard to make money in this zero return world, and one in which the central banks have been calling the shots. In terms of emerging markets, I think India looks promising, but it's expensive. So watch out for a correction in the Indian market, and I think you can buy it. I think India is a fantastic place to invest in. Turkey, it looks pretty cheap, and it's a favorite of mine. Brazil's moved up too much. Russia looks cheap, but it always has looked cheap. And of course, we know about the political issues and the severe overdependence on fossil fuels. And if you had to ask me, I would say that the oil and gas prices are probably at an equilibrium level at the moment. I don't think they're going to go up or down massively over the next year. But there's always a source of bad news in the world, and that source is from the bountiful basket case of bad news, which is, of course, Europe. Now, I don't know if you know this, but in 1930, there was a day on the World Service of the BBC, or whatever it was called in those days, and the announcers used to dress up in tails, even though they couldn't be seen by the audience, to announce the news. There was a day in which there was no news, and the BBC played piano music instead of announcing any news. There was no news. It was just incredible. So, ladies and gentlemen, today there is no news, but we can always rely on bad news from Europe. And this has nothing to do with Brexit, but I can tell you right now, my opinion is that the Eurozone is that is the countries that use the euro as a common currency, is coming to the end of its useful life. And that within 3 years, you will see such fissures as a result of the effective bankruptcy of France and Italy and continuing problems in the periphery, that bond yields will rise to levels that are unsustainable. If you want to look at what the normalized yields in Europe would do to the governments of Europe, in other words, if they had what should be the right interest rates in Europe, every single country in the Eurozone would be insolvent except for Germany. So I can see further bad news in Europe, but as you know, this time last year I told you not to short the euro anymore, and in fact to reverse and to use sterling to buy the euro, because I don't know which way the euro will go if it splits up. I don't know if it will be a strong euro that remains or a weak euro. I don't know what the division of spoils will be. But I can tell you that you're safer in a German banknote euro than you are in a Spanish banknote euro or an Italian banknote euro. So overall, I would be cautious about doing anything in the euro except to say that something is going to happen in the next 3 years. There is no growth in Europe. There is no potential growth in Europe. There's still very high unemployment in Europe. It's a tragedy. The European Union is a great idea. The thing that's destroying it is the imposition of the common currency, the one-size-fits-all monetary policy, and the continued tinkering around the edges by such people as Mario Draghi. Even the German finance minister, Wolfgang Schäuble, the other day blamed the growth of Alternative für Deutschland, which is the equivalent, I guess, in Europe of the Marine Le Pen organization in France, the National Front, blamed the fact that the European Central Bank was distorting everything with negative interest rates for the rise of right-wing populism in Europe. He may or may not be right, but the frictions, the fissures in the Eurozone are going to become much more evident in the next 3 years. And that is almost irrelevant to Brexit. I'm not making any political point here. It's just that Europe is not a great place to go for growth, basically. There are some good companies to invest in Europe. Now, Lorne Aberney, managing director or president or CEO, whatever he calls himself, but a brilliant man, is going to be speaking later on the technology. And last year, I wrote my book, Fast Forward, and now there's a company listed on the London Stock Exchange called Fast Forward. So I'm thinking up what the title of the next book will be, and then we can list a similar company. But Lorne has done an absolutely brilliant job, and he's going to talk about the future of technology later on this afternoon. I thoroughly recommend it. But I want to give you a couple of brief updates on where I see technology, because this is the really exciting part of being alive today, technology. You know, we're going through a bad period of investment, but sooner or later, technology is going to make us all rich. We're just in an interregnum between the second and third industrial revolutions, as some might see it, or the third and fourth industrial revolutions, as others might see it. One thing I want you to look at is the Dennard scaling. Dennard scaling is a fancy term for Moore's law, which stipulates that every 2 years, the price of semiconductors will go down by 50% and the performance of them will double. And that's been in existence for about 40 years. It really came to an end 3 or 4 years ago as a result of this Dennard scaling. And today, it's taking so much money to improve the performance of computers. And by the way, computing power is essential to the oil and gas industry, essential to the development of new aircraft, essential to lots of technologies. The whole process is slowing down. It's costing far too much to produce more computing power, and something has to happen. My friend Ilyas Khan has started a company, it's not here, but called Cambridge Quantum Computing, and I really like the whole area of quantum computing. If they can get quantum computing right, we move to a new scale of technology and humanity. And they are getting there. They are getting there. It will revolutionize the discovery of drugs. It will revolutionize, and it already is, cryptography. It's going to be fabulous, but it's not quite there yet. So watch out for quantum computing. We also know about virtual reality and augmented reality, and that's going to become a much bigger feature of our lives. You've seen the trucks running around in Europe, and the first example of autonomous trucking. I told you that 9 million jobs will be lost in the United States within 10 years as a result of autonomous truck driving. And I do think that one more thing on technology is important, which is that we are developing for the first time in history, or recorded economic history, what are best described as natural monopolies. natural monopolies. Now, most monopolies are the result of collusion. So I've got an oil and gas company, you've got an oil and gas company, let's set the price at this, and you'll sell 1,000 barrels a day, and I'll sell 1,000 barrels a day. That's an oligopoly, that's the development of a collusive monopoly. These natural monopolies result from the fact that in some areas of technology, the first mover or the first person to get huge scale crowds everyone else out of the market. So a good example of that is Facebook, right? So Facebook has, let's say, 90% of its relevant social media activity, and it makes a fortune as a result. Now, if the government comes in and says, this is a monopoly, we want to divide it in two, you have Facebook 1 and Facebook 2. Very quickly, what will happen is everyone on Facebook 2 or everyone on Facebook 1 will want to reconnect with all their friends on the other one, and everyone will move like a barrel of water swishing from one to the other, so you'll just get another natural monopoly. And I don't know how governments are going to deal with this, but you know, Facebook is not a trivial company. It's one of the world's biggest, most heavily capitalized companies. And these natural monopolies are now a very big feature of technology. So that's my observation on technology. But I want to also introduce you to, I'm going to move on from I've got the UK here. UK, yes, the UK. Sorry about this. Sterling's under short-term pressure. I don't think it's going to make any difference. I don't think the volatility will be nearly as high as people think as we run into a vote. And by the way, if I had to guess, I'd say that we're going to vote to remain in, and I couldn't care less about the opinion polls, but the bookmakers normally have a good take on that. I don't think Brexit's a financial issue. London prime real estate is soft, and it's going to go down a lot more. You just have to look at the cranes around London, and I would be a very quick seller of London real estate. And we do have a massive current account and fiscal deficit, which at some point is going to have to be addressed, but it doesn't seem really to affect the real economy. But the good news on the UK is that whether it's because of the European Union or not because of the European Union, doesn't really matter, is that we've overtaken. In my lifetime, I remember Germany being about twice as rich as per capita as the United Kingdom, and we've now overtaken all of those main economies. And it gives me particular satisfaction that we've overtaken France, and great satisfaction that we've overtaken Italy, because in the mid-1980s, the Italians had something called il sorpasso, which is when they overtook the British economy. Now look at them today. They are less than 2/3 of our per capita income. They haven't grown since 1999 in any respect, and we're doing much better than them. So that's a bit of patriotic talk interspersed into the thing. Here's the other 5 top 10 tech updates, and none of them really are relevant, except I want to talk about, I was listening to a presentation by Critical Elements, a lithium producer earlier on. I don't know if some of you were in there. Very interesting. And lithium is going to be massive, because whether you believe Tesla is going to produce the number of cars it says it's going to produce, all the car manufacturers are going to be into electric cars in the very near future, and demand for lithium will grow exponentially as a result of that. So already there's a huge shortage of lithium in the world. The economics of these mines looks fantastic, and there's not that many that can be developed in the world. And indeed, this company, which I'll talk about later, very, very briefly, is going to be a leader in this area, and is a very interesting company to invest in. So I want to give you now 10 rules for investment. These are random rules, but in this world of zero return, in this world, we have to be very smart. So first thing is be patient. Be patient. Peter Cundall got rich by being patient. That's a picture of him. Watch out for the word pro forma. Pro forma is Latin for bullshit, okay? Valiant, which you may have heard of, the fallen angel of the biotech sector, pumped up by pro forma balance sheets, pro forma earnings. What is a very signal example of that very thing. It's also an example of hubris by fund managers, because the great Bill Ackman, who was a sort of strutting peacock on the hedge fund scene, put 30% of his portfolio into this thing, and it's done him down so badly that it's entirely possible that his fund goes bust or is reduced to zero as a result of that. He's certainly ruined his reputation. That's the other thing, concentration risk. Don't put all your eggs into one basket. And Valiant was an example of a debt-fueled, easy money company that bought up a whole lot of stuff without knowing what it was doing with it. Now, it may come back, that's entirely possible. I'm not sure about it, but its shares have fallen from, let's say, $350 down to about $30 today, and it was one of the biggest biotech companies just a year and a bit ago. Look at the quality of management investment, I don't have to tell you that. That's why we love the Master Investor Show. We love it because you can meet the managements here. You can make your own judgment as to their credentials, their vision, and their skill at executing on their business plans. Look at the sustainability of return on equity. In the banking sector, I think they don't have a return on equity that's sustainable anymore. Goldman Sachs has gone from a 30% return on equity just 10 years ago to about 6% today, and it may well be it goes to absolutely zero. Look at the dividend policies. Look at whether the dividends can be sustained or not sustained. If you see a high-yielding share, it doesn't necessarily mean it's a good share to buy. And some of you will know that I read very widely. That's what I do. That's my job. I read. I read 40 magazines a week, and I read every serious newspaper every day of the week. My reading list will be made available to anyone who's interested on the email address that we put up at the end of this presentation. Don't have the foolish consistency that some people have. Don't fall in love with stocks. Be flexible and don't over-concentrate, all right? Cyclical stocks, rent them, don't own them. Cyclical stocks go up and down. Some of them you can buy at a low price and sell at a very high price, but there are very few cyclical stocks that are going to be growth stocks forever. They either get taken out by other cyclical stocks, or they go down again in the next down cycle. Be very careful of valuations. You can have the best company in the world, and I'm going to recommend some shorts here, which are good companies, but they're just too expensive. They can be shorted with impunity. And last thing, we've got some great people here, happy collaborators, people who are really interested in investment. If you go onto one of these rant rooms, fueled by bile, vitriol, red wine, and a lack of success, and by the way, Winston Churchill once said that the success for these type of people is stumbling from one failure to another without lack of enthusiasm, you are going to lose your money. You're going to be dragged down by these vipers and by these charlatans who have only negativity in their veins. Be positive about investment. Of course, there are companies you can short, but do it in a measured way. Don't do it because of hot tips or some rubbish that you read in what I call a rant room. Now, I did say last year was a difficult year for everyone in investment. We did better than most. We were up by about 4% last year. Not great, but it's better than the FTSE, which was down by 10, and the S&P, which was up by 1%, and it's better than almost every other fund manager out there. And of course, I don't charge you a fee for my recommendations. I do think this year, though, is going to be better because we're getting the changes coming from some of the central bankers. Some of them are going to introduce helicopter money. Some are going to put up interest rates and try and get the price mechanism on money right again, and that's going to give us an opportunity. So, our conviction ideas, the ones that I hope that I can come back and talk to you next year about that will have made you a lot of money. Normally, I don't believe that gold and silver are investments that I should be talking about here except as an insurance policy. An insurance policy, get on that last boat out of Saigon or have some in your bottom drawer in case there's high inflation or whatever. But I think because of the change that's coming, the inflation that's coming, and I can see it seeping in everywhere, and it's being reflected in the price of gold and silver, I think you should have a high percentage, and by that I mean 20 to 30% of your portfolio in gold and silver, either in stocks or in futures or in the physical or in the ETFs. I believe that gold and silver are going to have a multi-year breakout on the upside and that really more or less everything is going for them. And you could also add platinum to that list if you want to. Secondly, short, if you can, this is the converse of the gold and silver trade, any negative yielding bonds. As I said, fools and morons buy them, and we at Master Investor sell them. And there is an ETF which does do that. In fact, there are two of them, which I'm going to mention on the last slide in terms of forecasting or the investments that I'm recommending. Now, I like Japan, buy the Nikkei, but I think there's an old dog called Sony. You remember Sony? Walkman, Betamax, blah, blah, blah. Sony has got a huge installed base of PlayStations out there. And I think that Sony is going to be the leader, not Facebook, in virtual reality because of its massive installed base of nearly 40 million PlayStation 4s out in the world. And that Sony, which is developing, they've got 230 developers working on games at the moment, could be the surprise hit of the Japanese market over the next year or so. It's also got a great film business. So I think let's have some Sony in the portfolio. I put Fanuc in. We had 2 robot companies last year. We had KUKA in Germany, which has done very well, and Fanuc, which has not gone anywhere, really. And in fact, it's gone down, to be quite honest. I would buy Fanuc. I think it's a great business. The reason it's gone down has got nothing to do with its business performance. I would buy Fanuc. And then there's a really good biotech company, which is cheap as chips, about 7 times earnings, stuff full of cash. There are worries about whether it can maintain its pricing on its hepatitis C product. There are worries about its oncology portfolio. There are worries about everything, even its HIV portfolio. But it's a brilliant business, and I would buy that now. It's about $100 a share. I can see that going up by 50% over the next year. Then we got Critical Elements, which is a small company, so don't all buy at once, which is the lithium company that I mentioned earlier. I think they can develop a great mine there. I was impressed. I mentioned China. The Fidelity China Special Situations Fund, set up at exactly the wrong time. Set up when everyone wanted to buy and no one wanted to sell, by Anthony Bolton, as you may remember, a few years ago. Today it's selling at about a 20% discount. It's outperformed the broad Chinese markets, and I think for the next year that might be a good one to tuck away into your portfolio. The other element that's really been very good for us as investors in the last year has been graphite. And there's a new graphite company that my friend Anthony Bailey, who's here somewhere, has unearthed. And he unearthed 2 for me in the last year, which were Syrah and Triton, both of which were fantastic. And this is called Magnus Resources. And I don't even know where the deposit is. And there's me lecturing you about how you've got to do your research. And then lastly, it was one I recommended last year called Galapagos. It did really well for us. Galapagos is got a rheumatoid arthritis oral drug in very late stage development. Gilead's bought a share of them and is funding the development. They've got tons of cash on the balance sheet. I really like the trial data that's coming out from there. And they're going to be big in Crohn's disease as well. And then the last one is silver, to round off the, I think we had gold, and then we got silver at the end. And then there's other long recommendations there. And some of them are here. So Condor Gold is here, and you can go and talk to them. There's Avation, which I really like. I think the business model is fantastic. And you've got Synergy. My great friend Gary Jacob is manning his stand somewhere at the back, and I'd recommend having a chat with him. They've got basically an approved drug now for chronic constipation. It's a very big indication. And then as a sort of counter-cyclical play, Glencore, the best of all the mining trading companies, looks cheap. And my mining partner, Stephen Detells, is recommending that. Now, on the negative side, I mentioned negative yielding bonds, but I think we should go out and short some of these way overpriced American banker stocks, like the Nifty 50 of the 1970s or the big 5 companies of the internet boom in 1999 and 2000. Today, I would short Alphabet, which is the new name for Google. I'd short Amazon. And our shorts did very well last year, by the way, and I'd short Tesla Motors. I think they can't execute on producing enough cars to justify their valuation. They're at a negative P ratio of about 900 times. And then there's a couple of ETFs which allow you to short the German government bond and the Japanese government bond. And I'd short the US dollar, because the US dollar is on a downward slope at the moment. So in summary, ladies and gentlemen, it's all about the central banks. It's all about monetary policy. Forget about the politicians. Forget about all the noise. But I think a change is going to come. The unorthodox monetary policy may become more unorthodox in some markets as desperation sets in, and more orthodox in others. And there will be an effect of that. There'll be an effect of that, and that's what we're trying to play here. And inflation is coming, and I can already see the signs creeping in of inflation. It's this time of the year that I turn my attention to Christmas presents, because I like to have everything organized. And this caught my eye as a final thought for your Christmas. And we've all got relatives who, possibly don't get out as much as they used to, and possibly are not always in company, and so could do with some extra company. And you can, for a relatively small amount, now buy a robotic cat that can sit with Granny and an entertainer while you're out doing your investing. And several of my relatives have been marked down for, actually the price shouldn't be on there because they now know what I'm spending on their Christmas present. But that is my recommendation for Christmas. So I'm recommending investments, I'm recommending hats, and I'm recommending Christmas presents. What more could you want? Happy hunting, ladies and gentlemen. Thank you very much indeed. Thank you.